The continued trend of inflation worldwide has harmed the macroeconomic environment globally in this year 2022. The hitman with a double-edged sword. You guessed it, COVID-19. On one hand, we had the supply chain disruption brought on by the pandemic, and on the other, we had the ultra-loose monetary and fiscal policies by the Apex Bank and the government. The net effect of this has birthed decade-high inflation globally. Now I wish I could say it gets better, but sadly no. February 24, 2022, Russia shocked the world and only made a bad situation worse. With this, ladies and gentlemen, welcome to the 2022 Macroeconomic and Financial Market Review and Outlook. Kicking things off with perhaps the biggest talking point this year, Russia's invasion of Ukraine. Since the 24th of February, this conflict has weighed in on the global market. The crisis took a new tone with Russia formally annexing 4 provinces in eastern and southern Ukraine, and Ukraine announcing on its part its plans to join NATO. Crude oil, which is the major commodity export for Nigeria, rallied significantly during the year, peaking at a 13-year high of over $127 per barrel in March 2022. Now you ask, how do all of this weigh in on inflation? Well, it has maintained its dominance as the main talking point also this year. On the domestic and global front, we've seen record high inflation numbers, with the recent reading for Nigeria at 21.09% and the US inflation numbers printing at 7.7% in October 2022. Now you wonder, how has the currency fared also? The US dollar, appreciated significantly in 2022, rising to a 20-year high against a basket of currencies of its trading partners during the year. The greenback benefited from its safe haven status, and the rising yield in the US Treasuries market all but contributed to it. The central bank has maintained their hawkish stance across the globe, hiking interest rates to deal with inflation that is spiraling out of control. For context, US has increased the policy rate band from 0 to 0.25% at the beginning of the year to the current 3.75 to 4.00 band, with even prospects for further rate hikes going into 2023. Now you might ask, with these inflationary pressures and the hawkish stance from the monetary policy makers, what does the global growth prospect look like? Bleak, gloomy, depressing, I must say. For context, the IMF sees global growth slowing from 6% in 2021 to 3.20% in 2022. In the October's World Economic Outlook, global growth projection by the IMF though was kept constant for 2022 at 3.2%. However, that of 2023 was reviewed downwards by 0.2% to 2.7%. Again, as to global growth, the word is bleak. On the monetary policy side of things, monetary authorities in major economies are expected to remain on an aggressively hawkish policy path, though tapering the size of their rate hikes before reaching their terminal rates next year, with little consideration for a policy pivot to 2024. Now in the US, we expect the rate pivot in regions greater than 5%. In the Eurozone, the expectation is somewhere north of 3.5%. And in the same vein, the Bank of England will be looking at pivot in excess of 5%. Now let's take a close x-ray on our darling motherland. What does the Nigeria economy look like? Well, in the most recent GDP report, Nigeria recorded the 8th straight period of growth in Q3 2022, as the economy recorded a real growth rate of 2.25%, reflecting a 1.29% and 1.78% decline when compared to growth recorded in Q2 2022 and Q3 2021 respectively. Now the growth recorded was driven by a non-oil growth rate of 4.27% year-on-year in the review period, while the oil sector stayed in the contractionary region as it recorded a real growth rate of negative 22.67% year-on-year in the third quarter of 2022. The services sector, which accounts for the lion's share of the GDP, grew by 7.01% in the review period, Agriculture also grew by 1.34%, while industries remained in a contractionary region at negative 8.0%. Now, looking into 2023, what is the Nigeria economy outlook? There's still a lot of expectation in the non-oil space as we expect growth in this sector. Our optimism regarding the non-oil sector still recognizes the existence of inflation and geopolitical downside risk, although less predominant. The unending trend of contraction in the oil sector is likely to wane and possibly stage a rebound next year, drawing support from elevated energy prices and perhaps blockage of loopholes in oil theft. The steady performance of non-oil segments like ICT is expected to keep GDP growth above and as high as 2.5% in 2023. Looking at the inflation trend in Nigeria for the month of October 2022, year-on-year inflation rates for the headline food and core categories printed at 21.09%, 23.72%, and 17.76% respectively, relative to a 20.77%, 23.34%, and 17.60% recorded in September. The yearly headline inflation for September marked its 9th consecutive monthly uptick as foreign and local inflationary drivers nudged consumer prices upwards. Given the relentless uptrend in the prices of food and energy items, the ripple effect filtered through the food and core sub-indexes, consequently buoying the headline inflation in the review month. Now, looking at inflation, the question really, where do we go from where we currently are? Well, we expect inflation to print at 17.50%, and this is hinged on the retention of fuel subsidies, modest improvement in food output and supply, and stability in the foreign exchange environment. However, it could get better than this. Our best case scenario assumes that inflation prints at 15% going into the year 2023, and this also incorporates retention of fuel subsidies and appreciation in the exchange rate, significant improvement in local food supply, removal of restriction on food imports, and moderation in global energy and food prices due to reduced geopolitical tensions. However, on the flip side of this, looking at the worst case scenario, we expect inflation to print at 23%, and that is hinged upon removal of fuel subsidies in 2023, sustained depreciation in the exchange rate, elevated insecurity challenges could ignite inflationary touches in 2023, soaring global food and energy prices due to unabating geopolitical tensions. In the currency market, Nigeria lost 6.88% in the I and E FX window in the period, moving from an average spot rate of 415 naira to dollar in December 2021 to 445.67 recently. It's a total different ball game in the parallel market, as rates at the parallel market suffered a steeper decline thus far this year, crashing by over 25% from 575 naira to a dollar in December 2021 to 770 naira to a dollar currently. Well, it is clear. Now picture this: the effects of the Russia-Ukraine conflict on import bill, sustained hawkishness of central banks, reduced foreign capital inflows due to ravaging insecurity and election fears, and Nigeria's inability to generate adequate export earnings due to low crude oil exports. All of this sum up to our continued bearish expectation for the Naira. We expect the Apex Bank to continue to stabilize the exchange rate at the official market, while the parallel market continues to hover around the 700 to 900 Naira region. Nigeria's monetary policy is moving in tandem with the synchronized move by major central banks across the world to use monetary policy levers to assuage inflationary pressures. The MPC raised its benchmark interest rate by a total of 500 basis points in the last 4 policy meetings, putting the monetary policy rate at 16.5%. The MPC also raised the cash reserve ratio by 5% at July's meeting to 32.5%. Meanwhile, the asymmetric corridor was held at plus 100/negative 700 basis points around the MPR in 2022, while the liquidity ratio was pegged at 30% for the year. For 2023, the MPC should start the new year adopting a wait-and-see approach to better assess and appraise the impact of policy changes. However, We anticipate monetary policy normalization towards the tail end of the year as the base effect should ease inflationary concerns. At the end of 2023, we expect the MPR to print at 15%. Now you can talk about the Nigeria's economic condition in 2023 without factoring what's to come with the advent of a new president. We x-ray the key tenets of the main candidates. Brings to the question, are you obedient, articulated, or perhaps batified? For the article-led administration, the prioritization of a private sector-led infrastructural development should attract FDIs and give rise to infrastructure funds that will make for attractive investment vehicles. In the case of the Tinubu-led government, the emphasis on exchange rate stabilization could translate to renewed foreign appetite for fixed income instruments and equities, consequently spurring a rally across both markets. This could, however, halt appetite for dollarized investment like Nigerian Eurobonds. For an Obi-led administration, by drastically reducing cost of governance and investing in infrastructure and human capital to bolster local production, this could reinvigorate foreign interest in Nigeria's Eurobond and improve the ease of doing business. Still looking at the state of the economy, we keep a close eye on the Nigeria's 2023 budget. The budget for 2023 has been presented and it encapsulates assumptions like an oil price target of $70 per barrel, an oil production target of 1.69 million barrels per day, an exchange rate of 435.57 naira to a dollar, and 3.75% forecast for year-on-year real GDP growth and a 17.16% inflation target. Also, the government proposed an aggregate expenditure of 20.51 trillion naira and an aggregate revenue of 9.73 trillion naira, which would translate to a deficit of 10.77 trillion. Interested? However, our close examination of the historical trend of budget performance coupled with our assessment of the macroeconomic environment for 2023 reveals a divergent estimate for the 2023 budget. For aggregate expenditure, we expect this to come in at 20.77 trillion naira. The aggregate revenue is estimated at 7.40 trillion naira, and the deficit is expected to be 13.37 trillion naira. Now, let's have a quick look at the financial market, starting off with the Nigeria's fixed income market. The local fixed income market suffered sell-offs for most of the year as factors like the persistent rate hike instituted by the Monetary Policy Committee, low system liquidity, and increased borrowing nudged yields northwards in the local bond market this year. For 2023, we expect an estimated liquidity inflow of 3.48 trillion naira due in the first 4 months of the year to help drive yields lower in the period. However, the massive budget deficit of 13.37 trillion naira must be funded, and further interest rate hikes in the US would worsen the pricing of debt issuances from frontier economies like Nigeria. So the federal government would rather focus on more borrowing aggressively on the local front, causing a bearish bias for the rest of the 2023 year. In terms of liquidity, the anticipated liquidity inflow of 7.79 trillion naira is not sufficient to absorb the scale of local borrowing expected in 2022. We also expect the new FMDQ and SEC transaction charges could hinder volumes traded this year and in the secondary markets. In a manner reminiscent of the legendary F1 driver Mark Schumacher, the local equities NGX All-Share Index started off the year racing so good it was amongst the top 3 list of best performing index in the first half of the year. However, the market has been on a downtrend for the most of the second half due to the upsurge in fixed income yields as well as the waning appetite of foreign investors. Next year, we expect the downtrend to persist as a result of the FX crisis, rising interest rates, and ravaging inflation. However, we expect sectors like banking and telecommunications to outperform. For banking, we expect the net interest income of banks to expand given the tight monetary policy stance as the MPC has instituted a cumulative 500 basis point increase in the MPR this year. The underwhelming performance of lenders in 2022 could present attractive entry opportunities for investors next year. For telecommunication names, the trend of rising adoption of data-enabled devices and data offerings gives us a compelling rationale to maintain a favorable outlook for telecom stocks. The US equities market has suffered significant losses this year as the move away from an ultra-loose policy climate to a hawkish atmosphere triggered sell-offs. At the height of the market downturn, the S&P lost over 25% from January, losing nearly $10 trillion in market capitalization and suffering its worst first half of the year since 1970, while the Nasdaq and the Dow fell by over 19% and 34% respectively. Of all 11 sectors on the S&P 500, all except the energy sector were currently negative for the year. However, there's been some recovery in the second half of 2022 on the back of the better than expected earnings, alongside hopes that the recent moderation in the US inflation would ease the Fed's aggressive hawkishness. Looking ahead, on the energy front, while the geopolitically buoyed energy crisis has no clear end in sight, the stockpiling of LNG by Europe and fears of a global recession could tame energy prices going into the winter. Meanwhile, the broader market is still faced with major downside risks like the contractionary effort of the Fed and the unabating geopolitical tensions. And now we touch base on the African Eurobond market. The Eurobond market sustained a bearish momentum for most of 2022. Aggressive hawkish global monetary policy postures spurred sell-offs across the African Eurobond market. The Eastern Europe crisis also fueled sell-offs in the African Eurobond market, with Egypt especially being one of the hardest hit countries given our exposure to the geopolitical fallout. Other nations across the SSA struggled with some country-specific headwinds, as the likes of Kenya struggled with election uncertainties, and more pronouncedly Ghana was hit by concerns of fiscal sustainability. For 2023, the Eurobond market is expected to remain bearish as market participants continue to juggle inflationary concerns and ensuing interest rate hikes with geopolitical tensions from Eastern Europe and burgeoning concerns around fiscal sustainability.
Ladies and gentlemen, we came into 2022 with a lot of optimism, with a lot of energy. A lot of us had our strategy session in December 2021. We believed that 2022 was going to be a year of recovery. However, one thing we never thought about, the clog in the wheel, was the Russia-Ukraine war. The Fed insisted continuous rate hike. We never thought about that, and that was a major problem. That affected us globally. It affected not just Europe, it affected Africa as well. A lot of assets were being repriced. A lot of assets actually nosedived during the year 2022. But again, there were a few successes that, particularly in Nigeria, we recorded. You would agree with me that we experienced the growth in GDP between 2 to 3%. You could say that, oh, that's not so significant because we've seen 6 to 7% in the past. But 2 to 3% in a period where there was so much hardship globally was something that we should celebrate. One other thing that we should celebrate is the fact that the non-oil contribution to the growth in GDP was laudable. However, we had challenges with the oil sector. There was contractionary pressure from the oil sector. Anyways, that was 2022. Now we are at the end of 2022, and we're hoping that as we move into 2023 should be a better year for all of us. However, 2023 can only bode well for the investment community if only the journey with professionals. And that's what we do at Commercial Partners. At Commercial Partners, we lead you into the future. We are taking you into 2023 in a year that will certainly be full of uncertainties, especially in an election year. But we know that we have the capacity, the knowledge, the creative and innovative power to take our partners and our clients and our customers through this journey. As we embark on this journey, we pray that yes, you would believe and trust in us as always to help you to deliver all our promises. would like to express our profound gratitude for being there for us since the beginning of this journey. Since we started this business in 2016, a number of you took some chances in us, and we would like to say thank you for believing in us. For those of you that reposed your confidence in us, we cannot thank you enough because you believe in our capacity that we will certainly deliver on all our promises. As we go into 2023, we would like to say that thank you because we are believing that you would still continue to partner with us and ensuring that we continue to deliver on all our promises to you. We are always there leading you into the future. Thank you for believing in us. Thank you for reposing your confidence in us, believing that we will take you into the future.